Hello, this is for ISOL 631. This is for Chapter 8 in the textbook, Security Policies and Implementation Issues. And this chapter, Chapter 8, is IT Security Policy Framework Approaches. An information technology security policy framework supports business objectives and legal obligations. It also promotes an organization's core values, defines how an organization identifies, manages, and disposes of risk. A core objective of a security framework is to establish a strong control mindset and create an organization's risk culture. So selecting the right information security framework is important. There are a variety of frameworks in industry to choose from. A number of these are industry specific. Others offer a comprehensive view of IT that cuts across all industries. Which one is right for your organization will depend on the organization's needs, employees' experience, and the regulations that have jurisdiction. This chapter reviews various security policy frameworks. It discusses policy strengths and their positions in the market. Additionally, the chapter examines key elements from the frameworks such as roles, responsibilities, separation of duties, governance, and compliance. So the learning objective for Chapter 8 describes the different methods, roles, responsibilities, and accountabilities of personnel, along with the governance and compliance of a security policy framework. So the topics we will cover in this chapter include how to choose an IT security policy framework, how to set roles, responsibilities, and accountabilities for personnel, why separation of duties within an organization is important, what a structural approach to security policy and governance and compliance entails, best practices for security policy framework and approaches, and key concepts. Look at different methods and best practices for approaching a security policy framework. The importance of defining roles, responsibilities, accountability for personnel. Look at separation of duties and the importance of governance and compliance. We'll also look at the goals of this chapter, compare and contrast multiple frameworks, identify the top security policy frameworks, understand the types of roles needed to support these frameworks, explain the responsibilities of the roles, describe how roles create a separation of duties. We'll describe how roles create a layered approach to security, understand the need and importance of governance and compliance, and understand how these frameworks are applied in the real world. So information system security policy frameworks. How do you choose among the many IT security policy frameworks promoted by government agencies, corporations, and many others? There is no simple answer. Your choice will depend on your industry, as well as your management views of risk and any bias within your organization. You should focus on selecting standards that are widely accepted. No security framework can prevent all security breaches. At some point, a security event will happen. It could be as simple as someone sharing a password with someone else, or loaning a security badge to a colleague to provide unauthorized access to a restricted data center, or it could be a hacker stealing customer data. Whatever the security event, an assessment of why the breach occurred and what controls failed should be conducted. Depending on the severity of the security event, regulators may be asked for answers. Adopting the right security policy framework helps demonstrate to regulators that your organization follows security norms. Equally important, the effective adoption of security framework demonstrates that within a security event occurs, your organization can effectively respond to with minimal impact to customers and shareholders. So IT security policy framework domain model. The figure on the screen depicts a simplified framework domain model. Notice that a significant portion is dedicated to the governance and management of risks. This establishes the principle that managing risk and understanding business is a core competency. More comprehensive framework recognizes that the effectiveness of controls rely on the understanding of the business process. Understanding the business process allows you to better identify risks and design effective controls. Your first step is to determine the scope of the coverage of your framework. Then you can use it to filter to make sense of the various frameworks to choose from. Even a simplified framework domain model can help you recognize your organization's key areas of concern. You can create a framework that addresses specific weaknesses and aligns to your business requirements. So Risk IT Framework Process Model. So the figure on the screen is an overview of the Risk IT Process Model. The Risk IT Framework is built on 3 domains: risk governance, risk evaluation, and risk response. Each of these domains has 3 process goals. Each process goal is broken down into key activities. For this discussion, this section will focus on the domains and process goals. The risk governance domain provides the business view and context for a risk evaluation. This ensures that the risk activity aligns with the business goals, objectives, and tolerances. This includes aligning to business strategy. This domain ensures that the full range of opportunities and consequences are considered. The risk evaluation domain ensures that technology risks are identified and presented to leadership in business terms. Formal risks are analyzed and processes are created to assess impact. This domain also creates a risk repository of known risks. This further enhances the risk analysis and reporting. The risk response domain ensures the risks are reduced and remediated in the most cost-effective manner. This domain coordinates risk responses so that the right people are engaged at the right time. This prevents risks from increasing in magnitude. Processes are established to manage risk throughout the enterprise to an acceptable level. Next, we'll look at the roles. Managing access to data can be a complex issue. Data can be in emails, in a word processing document, or a file server, or it can be accessed through a product application. Regardless, data must be understood and protected. In the 7 domains of a typical IT infrastructure are special rules responsible for data quality and handling. The following individuals work with the security teams to ensure data protection and quality: Head of Information Management, Data Stewards, Data Custodians, Data Administrators, and Data Security Administrators. The head of information management role is the single point of contact responsible for data quality within the enterprise. This person deals with all aspects of information. This person establishes a guidance on data handling and works closely with the business to understand how information drives profitability. A business person, as opposed to a technology, typically fills this role. Data stewards are individuals responsible for ensuring data quality within the business unit. Data stewards are the owners of the data. They approve access. They work closely with information management to ensure the business gets maximum value from the data. They define the business requirements for data and create descriptions of what data is and how it will be used. Data custodians are individuals in IT responsible for maintaining the quality of data. These individuals make decisions on how the data is to be handled given the requirements from the data steward. Whereas the data steward's primary role is design and plan, the custodian's primary role is implementation. Data administrators are responsible for executing the policies and procedures such as backup, versioning, uploading, downloading, and database administration. And the data security administrators have a highly restricted role. They grant access rights and assess threats to the information assurance program. So roles and responsibilities. So the executive management, responsible for governance and compliance requirements, funding, and policy support. The Chief Information Officer, or CIO, or the Chief Security Officer, CSO. They're responsible for policy creation, reporting, funding, and support. The Chief Financial Officer, or CFO, or the Chief Operating Officer, COO, responsible for data stewardship. They are owners of the data. System administrators, application administrators are responsible for custodianship of the data, maintaining the quality of the data, executing the policies and procedures pertaining to the data, such as backup, versioning, updating, downloading, and database administration. Then the security administrator. They're responsible for granting access and assess the threats to the data. An organizational structure can help you a lot about how risk is managed. It defines priorities through the team's specialties. Defines how an organization perceives its threats. It also indicates how agile the response might be. The figure on your screen defines a theoretical information security organization in the private sector. That's the layer of executive governance of the security function in this example. Executive governance provides oversight for the security process and authority to execute. The Board of Directors establishes an audit committee to deal with the audit issues and non-financial risks. The Chief Information Officer reports to the audit committee through technology issues. The Chief Information Security Officer may also report issues directly to the audit committee. The Executive Committee helps set priorities, removes roadblocks, secures funding, and acts as a source of authority. The Security Committee members are leaders across the organization. This combination ensures buy-in from the business for the information security program. This is typically where a balance is reached between the needs of the business and the needs of the enterprise to implement effective security controls. The Security Committee may have a less formal relationship with the Audit Committee and the Operational Risk Committee. The committees will exchange information and on occasion agree to joint initiatives. Although less formal, there are key relationships. For example, the Operational Risk Committee provides important information on the risk appetite of the organization. Knowing the risk appetite can help the Security Committee understand business requirements and priorities at an operational level. Separation of duties. A fundamental component of internal control is the separation of duties, also called SOD, for high-risk transactions. The underlying separation of duties concept is that no individual should be able to execute a high-risk transaction, conceal errors, or commit fraud in the normal course of their duties. You can apply SOD on either a transactional or an organizational level. So a layered security approach. The layered security approach, which means having two or more layers of independent controls to reduce risk, can be an SOD, or separation of duties. Layered security levels leverages the redundancy of the layers, so if one layer fails to catch the risk or threat, the next layer should. By this logic, more layers should mean more risk reduction. However, more layers can be burdensome and expensive. There needs to be a balance between cost and return in risk reduction. The classic example of a separation of duties is when it's applied to the transactional level. If you have a high-risk transaction or combination of transactions, and you want to separate them between two or more individuals. For example, suppose a business sets up vendor accounts and issues checks based on the goods received. That business has three distinct processes: set up a vendor account, receiving goods, and paying the vendor. Having one individual control all three processes may prove too big a temptation for fraud. Such people would set themselves up as vendors and issue checks based on goods never received in one example. This type of fraud is reduced by assigning responsibilities for these processes to separate roles. So IT security controls. Regulatory compliance is a significant undertaking for a number of organizations. Some organizations have full-time teams dedicated to collecting, reviewing, and reporting to show adherence to regulations. This diverts resources that could have been applied to protect the business. IT Policies Framework helps reduce this cost by defining security controls in a way that clearly aligns the policies and regulatory compliance. The better an organization can inventory and map its controls to policies and regulations, lower its cost to demonstrate compliance. For a controls design view, best practices framework provide the mapping to major regulations such as Sarbanes-Oxley Act. As a result, the adoption of these frameworks is a quick way to demonstrate adequate coverage of regulatory IT requirements. So IT security controls are a function of IT infrastructure that an organization has in its control and the regulatory and business objectives that need to be controlled. You can have too many IT security controls impeding the organization from operating at optimal capacity, thus reducing its revenue potential. Generic IT security controls, as a function of a business model, they deploy a layered security approach, use SOD approach that applies to transactions within the domain of the responsibility, and conduct security awareness training annually. So applying the 3 lines of defense model. The first line of defense is the business unit. The business deals with controlling risk daily. They identify risk, assess the impact, mitigate the risk whenever possible. The business is expected to follow policies and implement the enterprise risk management program. The business unit owns the risk and develops short-term and long-term strategies. Ownership means that they are directly accountable to ensure the risk is mitigated or reduced. Second line of defense is the enterprise risk management program. The risk management program can be made of multiple control partners depending on the size and complexity of the organization. Operational risk management personnel and compliance personnel are examples of these control partners. They are responsible for the management risk across the enterprise. They align controls and policies to ensure that the risk management program aligns with the company goals. There is oversight of risk management across multiple risk committees and through various channels of risk reporting to stakeholders. Third line of defense is the independent auditor. That role provides the board and executive management independent assurance that the risk function is designed and working well. Additionally, the auditor acts as an advisor to the first and second lines of defense in risk matters. Third line must keep his or her independence, but also have input on risk strategies and direction. The importance of governance and compliance. Even the best of situations in an organization can be challenged to provide evidence that policies are implemented, enforced, and working as designed. The process includes collecting, testing, and reporting evidence. This can be tiresome and time-consuming, especially when an organization struggles to address what may seem to be endless audit findings. These audits can lead to retesting and more control deficiencies and risks identified. Implementing a governance framework can allow the organization to identify and mitigate risks in an orderly fashion. Once in place, the ability to quickly respond to audit requests dramatically improves. The framework provides the ability to measure risk in a few ways. In context of how well the organization has implemented leading practices, and in context of how much of the organization's risk is covered by the resulting implemented controls. A well-defined governance and compliance framework provides a structured approach, provides a common language, and also a best practice model for organizations of all shapes and sizes. A well-recognized framework standard provides a solid ground for discussing risk. It's a foundation from which information security policies can be governed. Business risks are defined as 6 specific risks. First, strategic. Strategic risks are a broad category focused on an event that may change how the organization operates. Some examples might be a merger or acquisition, a change in the industry, or change in the customer. Key point is that it's an event that affects the entire organization. Compliance risks relate to the impact to the business and failing to comply with legal obligations. Non-compliance can be willful or it can result from being unaware of local legal requirements. This could include regulatory requirements or legal binding contracts. Let's say a company accepts the rules associated with processing credit cards but fails to implement the CPI. The card companies, under a binding contract, can force the merchants to stop taking credit cards. Financial risk is potential impact when the business fails to have adequate liquidity to meet its obligations. This is when you fail to have adequate cash flow. For example, the consequences of failure to pay loans, payroll, and taxes would be financial risks. This lack of available funds may be due to a poor credit rating or operations too risky for banks to fund. Regardless of the reason, if you are unable to meet your financial obligations, there will be financial risk. Operational risks are a broad category that describes any event that disrupts the organization's daily activities. The Office of the Controller of the Currency, or OCC, defines operational risk as a risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. In technology terms, it's an interruption of the technology that affects the business process. That could be a coding error, slow network, system outage, or security breach. A reputational risk results from a negative publicity regarding an organization's practices. This type of risk could lead to a loss of revenue or to litigation. And other risks is a broad category of non-IT specific events that introduce risk. Typically, the category of risk relates to events that are outside the organization's control. For example, political unrest could occur in another country where the organization has a call center. The political unrest is a non-IT event. Lack of personnel showing up at work would impact IT operations. So best practices, security policy framework. Using a risk management approach to the framework, implementation reduces the highest risk to the organization. The ISA COBIT framework for SOX 404 requirements for publicly traded organizations is an example. Aligning the organization's security policy with business objectives and regulatory requirements. And the use of best practice methodology will best be answered based on organizational requirements and government regulations. So the GRC and ERM. Governance, Risk Management, and Compliance, that is GRC, is a discipline that systematically manages risk and policy compliance. Governance describes the management oversight in controlling the risks. The other framework approach, the ERM, is Enterprise Risk Management. This framework aligns strategic goals, operational effectiveness, reporting, and compliance objectives. So what's the difference between GRC and ERM? The terms GRC and ERM are sometimes used interchangeably, but that's incorrect. The difference is not in their goals. They both attempt to control risk. You can view ERM more as a broad methodology that leadership adopts to identify and reduce risks. There are similarities worth noting as in both approaches. They define risk in terms of business threats, apply flexible frameworks to satisfy multiple compliance regulations, eliminate redundant controls, policies, and efforts, proactively enforce policy, and seek line of sight into the entire population of risks. GRC is more a series of tools to centralize policies, document requirements, and assess and report on risk. Because GRC is tool-centric, many vendors have created GRC offerings. Not surprising that with vendors aggressively selling solutions, GRC has more momentum than ERM. It's not to suggest that there aren't tools to support the ERM process. Many of the GRC tools can be used to support the ERM methodology. But as a methodology, ERM adoption is driven by the organization's leadership. Lines between GRC and ERM do blur. In the real world, ERM teams deal with the governance and compliance issues all the time. They use many of the same tools and techniques. More and more GRC teams are reaching out to risk committees and teams to align efforts at a leadership level. So again, similarities between GRC and ERM defines risk in terms of business threats. They both apply flexible frameworks and both eliminate redundant controls, policies, and efforts. They also proactively enforce policy, and they also seek line of sight into the entire population of risks. The differences between GRC and ERM. GRC focuses on technology, a series of tools and centralized policies, and ERM focuses on value delivery. It takes a broad look at risk based on adoption driven by leadership. So in summary, for Chapter 8 of the textbook, Information System Security Policy Frameworks and IT Security Controls, we looked at the difference between the GRC and ERM. We looked at business risks associated with security policy framework. We also looked at the roles and responsibilities associated with the information security policy framework. Thank you.